So our risk isn't really $1,000, is it? What's the most we can lose? $610, that's right. That's our risk. So we're risking $610 per contract and we're making $390. So let's work out our return on risk. What's our return? So before we do that, let's work out, we had an example before we used $20,000, right? And we sold 1,000 shares naked. So let's assume we've got the same $20,000 just so we can compare the two. The same 20 grand, if we know we got 20 grand and we know the risk is $610, that's the most we can lose, the question then is how many contracts can we sell if we got 20 grand? If you've got a calculator, you just go 20 grand divided by 610, because that's the risk per contract, and that gives you 32 contracts. So now we can sell 32 contracts for our same risk of 20 grand. So our return is $390. That's what's going in our pocket. And we do that 32 times. Who's got a calculator? I want someone to check my figures. So that's now $12,480. Our risk is 610. And we're going to do that, again, 32 times. For those with a calculator, from memory it's 19,520. So now we're risking the same 20 grand, we're risking $19,520. Previously we're getting $450, now we're getting $12,480 for the same amount of risk. Previously we had 20 grand, we sold naked puts, and we got $450. With it, when we buy protection, we can do a lot more contracts. We can now do 32 contracts instead of one, and we're getting a return of $12,480 for the same trade. People often say to me, why do you buy insurance? You know, the chance of this going down, it hardly ever happens. You hardly ever need your insurance. Why do you do it? Well, that's why. $12,480 is why. Because we can make a lot more money because we're lowering our risk. So we can do more contracts for the same risk and get a lot higher return. That make sense? So what we do is we buy insurance at a lower price for protection. We buy insurance at $18.50 in this example. The result is that we take a trade that goes from 2.3% on our previous trade up to 63% for the same level of risk, with the same 20 grand we had. Okay, so that's 63%. 12,480 divided by 19,520, our risk is 63.9, about 64%. Let's annualise that. Okay, we want to see, okay, that sounds pretty good, but what if we did that same trade every 5 weeks for a year? 63% divided by the number of days, 35 days, times by 365 to get a per annum return. If you do that in your calculator, you'll see that comes out to be 667%. How does that sound? A bit better than 24? So all we've done is we bought protection, and that has enabled us to do more contracts, lower our risk, and get a lot bigger returns, a lot bigger wads of cash in our bank account. Let's just have a quick look at the two. The risk for naked puts was 19,050. With protection, it's 19,520. So basically, just a bit under 20 grand for both the naked and for the spread. Our return goes from $450 up to 12,480 for the same risk, roughly. Our return in 5 weeks is 2.3%, going up to 64%. But our annualised return, if we did that every 5 weeks, we're looking at 667% instead of 24%. So that's it. That's the strategy. Pretty easy, hey? Thank you. Thank you very much. So this is it. Write this down. There are 3 steps to this strategy. 3 simple steps. Number 1, we sell insurance. So we sell put option. Number 2, buy protection. So we buy a put option at a lower price. So sell insurance, buy protection, keep the change. That's it. That's the strategy. Pretty simple, eh? Okay, so 667%. That's pretty exciting stuff. Who thinks that's believable? Great. Who thinks you can do that over and over and over and over again? Great. Lots of positive people in this room. That's fantastic. What's wrong with this? What's wrong with what I just did?
Still risking capital.
Well, certainly we're risking 20 grand. That's right. How much money do we have? 20 grand. Who thinks it's a smart idea to invest all of their money on one trade? Glad no one put their hand up. So this is a real trade. I say this is a real number, and I'm going to show you in a minute. This is an average, actually slightly below average trade that we do. But there's no way we're going to put 20, if we've got 20 grand, we're not going to put 20 grand into one trade. That's just stupid. Okay, but believe me, I know lots of people who do exactly that. And if you do it, it's great, because your 20 grand turns into 32 grand if you get it right. But if you get it wrong, you're wiped out. Okay? So the secret to any investing you do, whether it's this strategy or any other strategy, is the way you manage your risk and the way you manage your account size. It's called money management or risk management. That's the most crucial thing. Now, the way we do this, we've got put together a little bit of a system which makes it a bit easier to understand so that you guys know how to manage your overall portfolio so that you can still get awesome returns, but you're only risking a small amount of your money at any one time. And if you do get a trade wrong, because you're going to get trades wrong, you know, I lose money. We lose money. It happens. But as long as we're only losing a small amount of our overall bank when we do lose money and continuing to make lots more money than we lose, then we're obviously well up. So the reality is you're not going to get 100% trading. So you need to manage your risk properly, and we do that with a little thing called a money pie, which basically works out exactly how we manage our trade sizes and how we manage our portfolio. Actually, guys, I might get you to switch back to up here so everyone on the sides can see what I'm doing now. So what we call a money pie is basically this. That's the money pie. So imagine you're looking at a big, nice, juicy apple pie, or if we want to be Americanised about it, we can be a pizza pie. And what this represents, this pie represents, is the amount of money that we've got for this strategy. Remember we talked about we do lots of other strategies, so we have other pies for other strategies. This amount of money is for this strategy only. Now let's say we have an example of, I'm going to use an example of $32,000. Only because it's nice and easy for me to work out and nice and easy for me to show you guys how it works. Now you may have 32 grand, you may not. You may have less than that. You may have a lot more than that. It doesn't make any difference. You do exactly this process that I'm going to do now, regardless of what your size of pie is. Okay, so whether you've got more or less makes no difference. All that does is change the numbers inside the pie. So, we've got 32 grand. Is it a good idea to invest 32 grand in any one trade? Of course not. Let's slice our pie in half. Now we've got two slices of pie at $16,000 each. So 50%. Is it a good idea to invest 50% of your capital in one trade? Let's slice it up again. Now we've got four slices of pie, 25% each, at $8,000, right? Who thinks it's a good idea to invest 25% of your account in one trade? It's okay, someone here said, yeah, maybe, it was a tentative maybe. Okay, so this is a key point because it's different for everybody.
Because of the amount?
Yeah, sure, because of the amount. So if you have a smaller amount, you might need to use slightly larger slices of pie. I'll cover that in just a moment. But the key I wanted to make there is that it's different for everybody. You know, you may have, when I was doing this when I first started, I would have been happy to invest 25% into one trade because I was young and dumb and, you know, full of, you know, just guessed I want to make lots of money. I won't finish that one. I want to make lots of money as quick as I can. So I was investing a lot higher risk. But I was comfortable with that risk. That's what I was doing. But now, you know, after I've been doing this for 10 years, there's no way I'd invest 25% in one trade. As I've got older, I've got a bit more mellow, and I'm more managing my risk. So everybody's different. You may think 25% is fine, in which case that's okay, as long as you understand that you're taking more risk. So for me, this is still too risky. Let's slice this up again. Now we got 8 slices of pie at $4,000 each. Who thinks that's a bit better? Getting there now? So that's quite a lower risk pie. So if we do a trade, we're only going to use one slice of pie and use one amount. We're only using a small amount of our overall bank. But for me, that's still too much, still too risky. We're going to slice this up again. and we got 16 slices of pie at $2,000 each. So what this means is that each time we do a trade, we know we're going to risk one slice of pie. Okay, we're going to choose one slice of pie, cut out that slice of pie and put that in a trade. And if we lose that, if that goes bad, okay, we've lost a tiny bit of our overall account. So that we know that if, we're not going to get trades that go perfect all the time. So if we have a bad trade, okay, that's going to happen, and we'll lose a small pound of our overall bank. But we've got 15 other slices that we can easily make that back. And if we're getting returns of 667% a year, we can make that back pretty quick. Okay? The other point to make here is not just we don't just choose a smaller amount slice of pie. What we do is we don't then rush out, because we got 16 pieces, we don't rush out and do 16 trades. Because then we've still got all our money in the market at one time. It may be split up in different trades, but that's still not good risk management. So what we do is we use a small amount. We might use 1, 2, 3, maybe up to 4 slices of pie at any one time. I can tell you, since I've been doing this for, as I say, around about 11 years, the most we've ever done is 7 slices of pie at once. The average is about 2 to 4 slices of pie at once, 2 to 4 trades a month. So we're only risking, even if all of the trades go bad, we're only risking a small portion of our account. Okay? So that's how we do it. And again, each of you guys, whether you've got more money or less money, you can work this out. So that you know this beforehand. So when you go to do a trade, you're not on the phone with your broker thinking, oh, how many contracts am I doing? And you know exactly beforehand, before you ring your broker, how much you're risking. So then you'd work it out like this. Can I get you to switch back for me? Thank you. So you work it out like this. Basically, we go, okay, we know that we've got $2,000 that we're going to risk on any slice of pie. So if we're going to do a trade, we've got $2,000. How many contracts can we do? We'll go back to this trade. Oops, it was over here, wasn't it? We'll go back to this trade on XYZ. What was our return? Sorry, our risk was $610. Okay, so if we know we've got a risk of $610 and we're going to risk $2,000, how many contracts can we do? 3, that's right, it's 3 point something. We can never do partial contracts, we round down. So we do 3 contracts. So our risk for 3 contracts is $610 for 3 contracts, and our return is $1,170. So our risk is going to be 3 times 610, which is 1,830. So we're not risking even a full slice. We're risking 1,800 in one trade. And for that, we get a return of $1,170. $1,170 in your account when you do the trade. So if you did that, if you continue to do that, and you did one trade with one slice of pie every 5 weeks, with an average premium of that, $1,170, that one slice of pie would return you over $12,000 for a year, when you're never risking more than $2,000 at any one time. So you imagine one slice of pie, imagine doing it with 2 slices of pie, 3 slices of pie, 4 slices of pie. And you can start to see how you can make some pretty good returns with well-managed risk. Everyone see that? Understand that? So at this point, normally I would do an example. I can't actually do that up here today for a reason, but I'm not going to run out of time as well. But I want to show you, so that's a normal trade. And just to show you, I'd normally do an example of a real-life trade to show you that this trade of 63% or 660% per annum is not a unusual trade. Because, I'm just up here saying that, these numbers, and you might think, well, is that true? You can certainly go and check that out yourself. But so what I've done is I just put together a quick table on our last 20 trades we've done and the return on risk when we entered. So this was 67% or 63% on this one. You can see down there, 80%, 67, 127%, 90%, 150%. So you can see that this trade of 63%, sorry, rather, is not unusual. In fact, it's quite low compared to what we normally do. And these trades are on our website. These are the ones we share. All our members get to see these trades. So these are real-life trades we've done. They're the last 20 trades we did. So you can see that 63% is actually one of the lowest returns we get there. So this example is actually not a bad trade, but it's a low trade. So if a low trade is getting you 63%, then you can see that we can start making some pretty good money by managing our risk correctly and being reasonably safe with our money pie and still getting some great returns. Okay, Should we take some questions?
What if the share price expires in between the spread?
Good question. What happens if the share price expires in between our two positions? Where did I do that one? So let's say share price goes along, and instead of, if it doesn't go down to zero, it just goes along. It's up here, it might come down a bit, go up a bit, come down and finish here. Let's say it finishes at $19.30. So in between those two positions. Okay, what happens then? Again, we explain all this in detail. This is one of the details of what you do if the trade goes against you. What we do there is we basically buy that option back. So that's our risk, the $19.50. The key point is we never ever buy shares in this strategy, ever. So even though we've made a promise that we're going to buy those shares, we never have to live up to that promise. Because all we do is we buy our insurance contract back. If the share price is $19.30, how much will it cost us to buy our $19.50 put option back? Anyone? 40 cents? Why is that? If the difference between the two is 20 cents, it's going to cost us 20 cents to buy it back before expiry. We've made a promise of $19.50 to buy shares at $19.50. The share price is $19.30. The difference is what we'd pay to buy that back. So we pay 20 cents to buy that back. We've originally received 39 cents, so we're still making 19 cents. Okay, so and that does happen from time to time, obviously. It doesn't always finish above there. I'll show you how we try and put the odds in our favour so it does. But when it does finish below there, we can simply buy the put option back. The worst case, all you need to know is the worst case is when it goes to zero. How much can we lose? We can lose the $1, which is the $610 per contract. So that's the absolute worst case scenario. Anywhere in between, okay, we can still lose, but that's the most we can ever lose. That's our maximum risk. Okay? I heard on the back, a couple over there. Yeah, anyway, it doesn't matter. We'll take a few questions, so we're right.
What's your win rate? I mean, you're assuming a pretty high win rate here to be profitable.
No, well, not really, but I'll show you that in a moment. I'll show you that afterwards. Yep, very soon I'll show you exactly where win rate is and what the results are. But don't forget, because when you say we need a high win rate, we're making profits of, as you saw on that screen, 60% up to 150%. So if we're making 100% profit, if we lose one, how many do we need to make it back? One next trade makes it back. So we don't need a high win-loss ratio at all. And that's why it's so successful, because we don't need to have a high win-loss ratio, but we do, and that's what makes it so successful as well. So remember that, see, in this trade, what do we need the stock price to do to be profitable? We don't care if it goes up a lot, it goes sideways, it can even come down a little bit. We just want it to be above 1950, and that trade will be 100% profitable. So if we're doing a trade where we don't need it to go up, it can just do nothing, it can go sideways. And we still make a return of 63%. Not too many other strategies can do that, where you don't even need to be right, and you still make that sort of returns. So remember, the stock price, as we said, can go up, sideways, down. We can get 2 out of 3, or even slightly down, anywhere above there, and we're making good money. So that's why we have such a high win-loss ratio, is because we don't actually need the thing to go up. And that's the problem, not the problem, but we're talking about different strategies, is that with other strategies, the stock price or share price has to move in a certain direction, otherwise you're not going to make money. There's very few strategies where you make money when it doesn't move, right? This does. It can go up, great, we make money. It can go sideways, great, we still make the same amount of money. That's what makes it such a high win-loss ratio. Yep. And I'll take one more. Pretty good.
We are selling insurance at 1950 in 45 cents. And who is going to give us in 6 cents on 1850?
Who is going to do that? So the question is pretty much, okay, so you're comfortable with someone buying this insurance, but you're worried about who's going to sell us this insurance. Okay. The Australian market is done, 90% of the options market is done through what's called market makers. Okay? When I talk about buying and selling insurance, people obviously buy insurance, but the majority of people who trade options are the market makers. So when you put in it's an open market. A market maker is that there's people who are paid or have a mandate by the ASX and by the Australian government to provide a market for options. They're called market makers. They're basically the big banks, big institutions, and they provide a market. So when you go, I want to buy a put option at 1850, the market maker has to give you a price for that. He has to give you a price. So there is always someone to buy and sell your options. Now you may not like that price, in which case you don't do the trade, but you know that beforehand. Okay, so he might say to you, well look, okay, I'll sell you the 1850 put option, but I want you to pay 20 cents. And we say, go to hell, I'm not going to pay it. So obviously it's an open market. When we get the price we want, then we do a trade. Okay, so it's an open market like anything else. There's always, just don't worry about, people often think, but who's buying that put option? Is it Joe Blow here, and then when am I going to buy it back off him? We don't think like that. It's an open market. All you do is the broker does it into the market and it gets filled. Okay, so don't worry about why or how that happens. There is always someone available to buy and sell our options. So what I want to talk to you now about is basically what we call the trading diary. Everyone understand this basic principle? Everyone can see how we use it to generate income on a regular basis? Yeah, you can see how we sell insurance, buy protection, we keep the change. That's basically the situation we do, and we can do that over and over and over again. So everyone got the basic understanding of what we're doing there? As I say to you, the devil's in the details, but we teach you all that in the e-books. But I just want to make sure you get the exact principle of what we're doing and can understand how we do it, and you can see that, okay, this can make some good money. So what we did with the trading diary came about almost by accident. Megan said earlier that I was a graduate of 21st Century Academy. It was about 11 years ago now. I was sitting in the chair just like you guys, watching Jamie up here talking about things. And what happened was that we then basically discovered this strategy. Myself, my wife, and another couple were here together, and we went and worked this out. We need to replace our income. And we worked out basically this strategy. It took us a few years to get it perfect. But what happened was that once we started doing it, I was able to earn enough money that I was able to go from working 5 days a week at 12 hours a day down to 4 days a week. Then after that, my wife was able to retire, and I went to 3 days a week. We're earning more and more money, our pie's getting bigger and bigger, our slices of pie getting bigger and bigger. I was able to go down to 2 days a week, earning more and more money. So it's not something that happens overnight, but it is something that we can build on, and as you get more and more money, you can start going down to lower hours. And then I was able to basically retire completely. Went from 2 days a week to quitting and not working at all, living off this investments. So obviously along the way, people were saying, how the hell are you doing this? Friends and family were asking the questions, how are you able to do this? So we basically wrote a little ebook which explains